Welcome and good Wednesday morning, everyone. Happy to have you along here today for our crash course. See the crash test dummy in short-term care policies. My name is Randy Lober, Growth Marketing Manager here at Action Benefits, and part of my role is to help you, our loyal health insurance agent partners, understand some of the products that we offer here at Action Benefits and that you can offer to your clients. And that's what we're going to spend a lot of time here doing. Well, not a lot of time, about 40 minutes of time here doing today is figuring out from top to bottom what are short-term care policies and how do they work. Joining me today is Chelsea Gomez. That's a happy name change. So you can feel free to give her all of the congratulations in the chat. Chelsea, go ahead and say hi to the people before we get started.
Hi, everyone. Thank you so much for coming here and spending some time with me and Randy to learn about some of your options that you have with Action Benefits with short-term care policies. Any questions you have, go ahead and let them loose in the chat and I will get to them as soon as I can. But otherwise, thank you. Welcome to the show and just sit back, relax, learn a little bit about some short-term care policies with us.
But don't relax just yet. We're going to put you on your toes here for a moment. Get you into a mindset of why these policies fit the market and who they can be a good fit for. So get your typing fingers ready. We're going to ask you to type a few things here in the beginning. A few questions here just to warm you up, get you thinking about what's going on. So in 2025, the average cost of a semi-private room in a nursing home is blank dollars per day or blank dollars per year. Is that choice A, $265 per day or 96,000 roughly per year, B, 302 per day, 110,000 per year, or C, 600 per day and 219,000 per year? Put the letter A, B, or C. What do you think the approximate cost for a semi-private nursing room is?
Some of those numbers are more than I paid for my house.
Right? Good mix, good split between A's and B's coming in. If you have chosen B arbitrarily here, you are correct here. And on average, your clients could spend $302 a day for a semi-private room, $110,000 per year for a semi-private room in a nursing home. That is a hefty amount of cash. In 2025, the average cost of a registered nurse for a 10-hour workday, so it's a nurse to come to your home, take care of you, is that about $195 per day, B, $220 per day, or C, about $400 per day? Which of those sounds right to you? Please put A, B, or C in the chat. Robert, and those of you choosing C, you are absolutely correct. In this case, the average cost of a registered nurse to come to your home, take care of you for a 10-hour workday is about $400. That can be a hefty chunk of cash as well. And someone turning 65 today, how likely is it that they're going to need some amount of skilled care between now and the time they leave us? Is it a 70% chance, a 30% chance, or a 50% chance? Yep, it is, in fact, a 70% chance that they may need home health care or skilled nursing care between now and the time they leave this earth. And of those needing skilled nursing care, last question for you before I take the lead here. Of those needing skilled care, what percent of them need less than 1 year of at-home care, and what percent need less than 1 year of in-facility care? Is it 42 and 58, 42 and 37, or 37 and 42, a flip-flop of those last two numbers? Which of those sounds right to you?
This question and the last question, like all of them seem kind of low to me, to be honest. I'm sure they're right, obviously, but man, like if you were to ask me, I'd say like everybody needs care towards the end of their time here.
And for those of you like Jessica today, chiming in with B on this one, you are absolutely right here as well. So about 42%. So if you are one of the 70% that needs skilled nursing care, 42% chance that you're going to need less than 1 year of at-home care, and about a 37% chance that you'll need less than 1 year of facility care. So less than 1 year happens to fit the definition of short-term care, and that's what we're talking about here today. And in the insurance industry, you're all about protecting your clients from potential risks. In fact, and based on some of the financials we talked about a few moments ago, that short-term stay in a nursing home or that short-term health home care nurse, a registered nurse, can add up really quickly. Your clients are very likely to need skilled care, and they're going to need a way to pay for it. And it's chances are that their major medical coverage aren't going to do it for them. They might have to tap into savings, or they might have to drain retirement accounts to get there. All of those are options. The one thing that's really not an option in this case is Medicare. Medicare has very limited coverage, all things considered, when someone does need skilled care. When someone enters a nursing home, Medicare will only pay for those first 20 days, and only if your person met your client met the 3 midnight rule or the 2 midnight rule, the 3-day inpatient stay beforehand. When someone's in a nursing home, Medicare's only paying for the skilled care as long as it's necessary on a daily basis. It doesn't pay for personal care, so it doesn't pay for the aides to come in and help someone with bathing or other activities of daily living. It's called just only looking at the skilled care, the doctors and nurses that will attend to that person while they are in the nursing home. And Medicare will stop paying when skilled care is no longer required, and the patient stops showing improvement, or they hit the maximum allowable benefit under Medicare, typically around 100 days, unless they have reserve days they can bump into there as well. So Medicare only up to 100 days. Well, if I'm in the facility or need home health care longer than that, that's not really going to help me out beyond that coverage limit. So there's a problem here, right? There's serious gaps in Medicare. There's serious gaps in what your Medicare Advantage or your Medicare supplement might cover for your clients. So what do we want to do today? We want to talk about some key differences between short-term care and long-term care, both from the client protection side, but also between your obligations as an agent in selling and servicing those policies. We'll take a look at some of the products offered by our partner carriers from Guarantee Trust Life and Wellaby, and find the right product fit for your portfolio. And then we'll talk about some ways that you can position those plans within an appointment. So as promised, we'll start by taking a look at short-term care versus long-term care. And this table is a really handy way to do that. On the left-hand side, you see short-term care. On the right-hand side, you see long-term care. You have two good eyes, generally speaking, so I won't read the whole thing to you, but there's a few key things that I want to point out for you. Generally speaking, short-term care policies can either kick in and cover facility care in a facility or care at home, but you can add the opposite care setting with a rider. Generally, your long-term care policies are focused on or developed around care provided in a facility, but they can offer home care with a rider here as well. Different benefit limits to keep in mind. Your short-term care policies will only cover, generally speaking, up to 360 days, because any longer than that, they become a long-term care policy, which generally are good for anywhere between 1 to 5 years. Because they provide shorter coverage, of course, their premiums are going to be lower. A big thing to consider, especially when writing these policies, as well as the elimination period. If you work in the supplementary benefits space at all, the voluntary benefit space at all, you're familiar with those elimination periods, say on a disability plan, right? Or the group disability plan, where you have to wait X amount of days, Y amount of days before the plan will start paying. For short-term care, generally you can go between 0 and 20 days. On long-term care, though, they'll put you in the facility for 90 days, but up to 365 days before their benefits start kicking in on that elimination period. So there is actually a pretty good opportunity to stack the two plans together here, right? You could use a short-term care to bridge someone over to when their long-term care elimination period would expire, and their benefits would kick in here as well. But again, there's some premium concerns that you might want to worry about there. Both plans do tend to cover medical and non-medical services, so they do cover custodial care, like bathing and things like that, not just the skilled medical care provided by a nurse, provided by a doctor. Different benefit amounts to keep in mind there. Generally, short-term care is based upon the day. Long-term care payouts are based upon a month of care. The application process, long-term care is by far the harder policy to get because there's detailed health questions. There's a medical record review. There is a medical exam. Neither of the carriers that we work with for short-term care require a medical exam, and there's fairly simplified underwriting, just a few questions on each application to get these policies here. And generally speaking, these benefits will trigger when your client is unable to perform or unable to perform 2 activities of daily living, or they have a cognitive impairment that requires supervision. Those activities of daily living, dressing yourself, clothing, toileting, walking, those sorts of things, all those 7 things from your licensing classes. If your clients can't do 2 of those, their benefits would kick in for this plan. So quick difference between the two, I ask you to weigh in here in the chat. Short-term care policies, which of these statements are true about short-term care policies? A, do they pay out when a client is temporarily unable to care for themselves? B, do they have lower premiums and simpler or easier underwriting of long-term care products? C, do they not require additional education to sell? Or is D, all the above true about these plans? Which letter or letters might be most closely describe short-term care policies based on what you know so far? Got a few star pupils out there today, chomping at the bit to get their answers in. Give you a few more moments to get what you want to say here in here as well. And if you are like one of the star pupils saying D, all of the above here today, all of these are true. That's what makes them a good fit for both you and your clients, right? Long-term care policies do require extra education and extra recertification for you to be able to offer it and sell those things. As long as you have a life and health license here in the state of Michigan and are appointed with either GTL or Wellaby, you can sell either of these short-term care products and help bridge your clients should they need care either at home or in a facility. Speaking of products, let's talk about the product fit. We're going to take a medium dive, not too shallow, not too deep, into some of the plans that our carriers offer here today. Namely, we're going to put these 2 products side by side. We're going to look at Wellaby's Essential Care Plus family of products and GTL's Recover Cash short-term care products. First thing you'll notice about these products, where they stand apart, is the issue age. Wellaby will issue up to age 89. Guaranteed Trust Life will only issue up to age 84. Both of them guaranteed renewable, though, so long as they haven't exhausted their lifetime benefit amounts on these plans. But Wellaby may cover pre-existing conditions based on underwriting and how they answer questions during the application process. However, if you happen to be selling to a couple, so a pair of spouses, and one of the spouses is in generally good health while the other is not, they may cover for coverage, or better coverage, so to speak, if they have another healthy applicant on that application. So that is something to keep in mind. Wellaby will kind of offset some of that risk by taking on some good risk on their books here. Guaranteed Trust Life approaches their underwriting a little bit differently. They do exclude any hospitalization or treatments for the first 6 months due to a pre-existing condition, and they will also look back 6 months at medical records to look at any pre-existing conditions there as well. Both of their benefit triggers are the same. You got to satisfy the elimination period on the plan if, in fact, your client bought one. If your client, these benefits kick in if your client is unable to perform 2 ADLs without assistance or supervision, or your client develops a cognitive impairment requiring substantial supervision. So they need round-the-clock care or round-the-clock supervision in order to live a safe and healthy life while they are recovering. The base benefits, the 2 carriers take 2 very different approaches to how to design their coverage. And for me, I think that what I'd keep in mind if I was kind of just, ruminating on these or letting these marinate for a minute is that Wellaby really focuses on the home health care plans. You can add a rider to kick in for facility care. GTL takes the opposite approach, where their primary benefit, their base benefit, looks at facility care, but you add the riders on for home health care if that is something your clients are interested in. So that's probably the first question you ask yourself as you are thinking about which you might put in front of a client or which you might ask them, or which you might prepare the quote for, is are they more likely to need home health care or facility-based care? And you certainly don't have a crystal ball, so that might be a tough question for you to answer, but that's a good starting point. Especially if they have certain conditions that might make them predisposed to one or the other. They do have a variety of base benefit periods that you can build when you're building the coverage. Remember that long-term care elimination periods typically are around 90 days. So you could build a base benefit here on this plan that bridges the gap to the 90 days there. But again, they cap out at 360 days of care on both their base benefit periods. They do have a lifetime max on these plans. They will only pay the benefit out twice. So you have a maximum of, having short-term care benefits for twice throughout your lifetime. Both have a choice of $0 or $20 elimination periods. And both of them work in $10 increments when you're looking at the coverage amounts. Wellaby, because they're focused on that facility care, the home health care, they go from $10 to $300 in $10 increments. Guaranteed Trust Life starts the floor a little bit higher, $50 to $300 per day on that side. Because again, the plans are structured a bit differently on what they see as the base benefit. Included on that Wellaby plan, if you don't buy any riders, your clients will also get a $500 reimbursement for any household improvements that they might need to make to help them live with that disability in their home. And they'll receive a $500 care coordination benefit to help them get from place to place or handle their appointments or so on and so forth. Because GTL is built on that facility care as sort of the core benefit, they do include a bed reservation policy. So if someone leaves the facility care, the short-term care facility for a few days, but needs to go back, GTL will hold them for that bed for them for 10 days and will hold them up to that bed for a lifetime maximum of 20 days, just in case going home doesn't quite work out the way that your client would hope. So because they have different base benefits, they have different riders associated with them here as well. So Wellaby again on the left, GTL over on the right. On that Wellaby plan, you can add the nursing facility care rider up to $500 per week in $10 increments. Either a 0 or 20-day elimination period. You have a variety of benefit periods you can work on there as well. They will hold the bed reservation per stay up to 21 days. So a little bit richer benefit there if you add it on compared to GTL's base benefit on the short-term care plan. They do offer an adult daycare rider that can be helpful, especially if you have caregivers in the family who might need a respite from taking care of the person who is incapacitated at the moment. $50 per visit, up to 20 visits during a benefit period, which can be helpful. There is an inflation protection rider that you could consider adding here as well. We know that the cost of care never gets cheaper or hasn't gotten cheaper. Home health care is going to continue to increase. So is nursing facility care. So you can add a 5% simple inflation rider onto one or both of those core benefits. And there is a return of premium, up to 50% return of premium on that policy if your clients so choose, or you can see the benefits broken down there on the left. They will restore benefits once, and they do offer some household discounts, either 5%, 7%, or 14%, depending on the whether there is the number of policies essentially held in the house. So if the couple has their Medicare supplement policy and a hospital indemnity policy all through Wellaby, they're going to build their discount all the way up to 14% discount here on the home health care plan. The other policies have their own discounts that might apply there as well. On GTL, you're looking at adding the home health care rider, because remember, their core benefit is the facility care. So they offer $50 to $1,400 per week in $50 increments. Again, a 0 or 20-day elimination period. They will cover that for either 26 or 52 weeks as you build that benefit. What they do provide, though, is a $3,500 family caregiver benefit. So that is an indemnity style benefit, so long as you can prove that someone is giving care and is a family to the person that is incapacitated. GTL will flip them or provide them up to $300 or $3,500 to pay for respite care or to pay for those adult daycare visits. Different ways to accomplish sort of the same mission there as you take a look at that. They do offer inflation protection riders as well. Again, there's a 5% simple option or a 5% compound over the life of policy. The compound, of course, is going to be the more expensive rider because compound inflation, compound interest, compound anything gets you to quick higher numbers faster. Benefits on those plans will restore once, and there is a 10% spousal discount available with GTL here as well. So again, 2 different sets of base benefits gives you 2 different sets of riders, but put them together across either carrier, and you've got roughly the same coverage with a few tweaks here and there.
Before we get into the
here.
rates
ahead,
really quick, I just wanted to show, I think it's really, Wellbe and GTL have 2 very interesting ways to get those out there. The quotes for Wellbe, I'll put you those out after we talk about the quotes. But GTL, I put the link in the chat really quick, has a really interesting way of giving you guys the brochures for these plans. It's called a flip snack. I think it's really cool. The link will show every single plan that GTL has, and you can click through and download all of the brochures. So you can get a little bit of a deeper look into some of those benefit plans. And I also wanted to point out that just because we picked this one particular plan for comparison purposes, because that's what made sense for what we were doing, there are more than one plans with GTLs for short-term care. So if you check out that link that I put into the chat there, you can look at all sorts of different plans from GTL, including the other short-term plans. I just thought that was really unique and different for a carrier to have something like that. It's the only carrier I've seen that's done something like that to display their carrier brochures or their plan brochures.
Thank you, Chelsea. Keep in mind, though, that as you look at those products, not every product is available in every state. So you would want to go log into your GTL portal and confirm that what you're taking a look at is available in the places you plan on selling it or marketing it. Taking a look at some sample rates, for someone who is 65, both carriers, which is nice to know, do provide unisex rates. So male or female does not make a difference for this particular plan, although it does make difference on other policies. Someone who is 5'10" and 176 pounds, so a relatively average build. If you take a look over, and these are screens, sorry if they're a little small, they're screenshots directly from the carrier's software, but I wanted to show you kind of apples to apples comparisons. If I build the same benefits, I come out to nearly the same rates from within a few dollars of each other here, as you can see. But if I start with that Essential Care Plus plan, that is, should mention that Wellbe offers 2 tiers of benefits. Essential Care is what you get kind of shoveled into if you don't meet all of their underwriting criteria. But if you do pass all the underwriting criteria, you qualify for the richer Essential Care Plus plan. Base benefit there, again, for your home care of about $67.30 per month. And that's a $300 benefit for 360 days with a $0 elimination period. So it comes out to $67 just for that benefit. But we know that at home is not the only place that you can get care. So we did add the nursing facility care rider over here, $300 for 180 days with a $0 elimination period, plus the adult daycare rider here as well for 50 cents. Makes a ton of sense, right? No pun intended. coming out to 139.72 on that side of the house. GTL, again, remember they build their benefits the opposite way. So they start with that nursing care rider. If I start with that nursing care rider with the $300 per day, 180 days, 0 day elimination period, premium for that is actually a little bit higher, but their home health care premium is a little bit lower for the exact same benefit, $1,200 for 52 weeks, comes out to $134 there. So again, you're generally speaking, and I ran the rates at a variety of different ages and builds here, generally within a few dollars of each other. If you're already spending $130 a month, that $5 may not make much of a difference to your beneficiary, but generally GTL rates out a few dollars lower than Wellaby will. So all that considered, what's the big deal here? If I wanted to give you some big takeaways, Wellaby's Essential Care does perfectly fine at balancing both sides of care, whether you're in home or in a facility. That home improvement indemnity style benefit is a bonus though. We know that if someone is disabled, they may have mobility issues. Having a few extra dollars in your pocket to be able to adjust the home can help with that. On the other side, GTL's Recover Cash. Again, they build the coverage the opposite way, but they do a great job of balancing both sides of care. But they really do focus on that caregiver benefit. That $3,500 is fairly rich benefit you can go with. If I were you and I were building my portfolio, I'd also kind of want to look at my client base and the other products I'd offer. I don't know that all cards on the table that either of these is a difference maker saying, oh, you've got to go Wellaby or oh, you've got to go GTL because they're short-term care plans. But if you already have one of these on the table, right? Say you already appointed with Wellaby because you like their wider guaranteed issue range on their hospital indemnity plans, or you like the having an additional med sup option in your pocket. It's nice to know about short-term health care before so you can put it in front of clients as you have those discussions. But I don't know. I would carry at least one of these, but carrying both of them, your mileage may vary based on what your clients are looking for here. All that said, quick knowledge check for you. The following short-term care policies have a guaranteed issue period. Is it A, Wellaby's Essential Care, B, GTL's Recover Cash, or C, none of the above? Which of them has a GI period?
While you're typing in your answer, I just wanted to point out, I already put it in the chat already, but there is a link there to use the Wellaby's quoting tool for the short-term care plans. It is pretty cool because it kind of outshines the GTL one because you don't need a login to use it. You could click on it right now and start playing along at home and whipping up a quote for yourself if you wanted to while we were doing this. I just thought that was pretty nifty.
Thank you, Chelsea. And for those of you weighing in, you are correct. The answer is C. Neither of these policies do have a guaranteed issue period. Both of them do require medical underwriting, but not as significant of underwriting as a long-term care policy might be. But keep in mind that there is no GI period here. Your folks will have to get through underwriting either way. We want to spend the last few minutes of our time together here today talking about how you might put these products in front of your clients during an appointment. That's often sometimes the hardest part of bringing up a supplemental product is figuring out where it fits in the conversation or figuring out how you're going to get there. So we'll give you a few tips and a few words, a few sentence stems you might use to incorporate in your appointments. So one way you can bring these up or bring up any supplementary product is through your objection handling. So typically at the end of every appointment, you've done a great job. You have really helped to hear your client concerns, but you also want to make sure that there's nothing they're worried about. So when you ask, what worries do you have about your health plan, or what worries do you have about your current health plan? They might say, well, what if I do need what if I am hospitalized? What if I am laid up for a while? And that's a great opportunity to segue into a conversation about short-term care coverage. You might also ask a more thought-provoking question to bring these up. Do you know the difference between a long-term care and a short-term care policies? No? Well, let me tell you about it, and let's talk about whether or not they're a good fit for you. Or who will take care of you if you can't care for yourself? They may have family nearby. They may not have family nearby to be able to take care of them for a while. But even if they do have family nearby, there's no guarantee that they'll be able to deliver the level of care that your client may require. So another way to open up that conversation about short-term care as you go forward. You can also, if this fits your style, be a little bit more assertive, assumptive in your question here, and ask simply, who's your short-term care policy with? Make it the most matter-of-fact, run-of-the-mill thing. Make it sound like everyone has one of these, and they need to consider that here as well. So, Ms. Smith, who's your short-term care policy with? You don't have one? Let me talk to you about some options here. And some people tend to prefer a more nonchalant approach. In the same way that the cashier at McDonald's asks you, would you like to supersize that or would you like fries with that? You can talk about short-term care or any other benefit really in the same way. Would you like a short-term care benefit with that? Yes or no? And that gives you opportunities to take that conversation wherever your client wants to take that. But the main point here, no matter which of these fits your style or which of these fits the conversation, is that they give you the opportunity to show the full menu of products you offer and give you the opportunity to have the conversation. Your clients will never enroll in a plan if they don't know you offer it. In fact, it's impossible for them to do that. So all of these give you a way that, again, could fit your style to get talking about those products. If you don't have them in front of you, though, you don't have your clients in front of you, and instead you are looking for ways to reach out throughout the year, you could use an email or a voicemail script that sounds something like this. Hi, Miss Smith. Thank you again for trusting me with your health insurance plan. You should have gotten a lot of material from whoever the carrier is about your new plan. Did you get it? What questions do you have? And there's a short-term care benefit that can offset your costs if you're unable to take care of yourself. I'd love you to focus on treatment or recovery, not struggling to pay for that nursing home. Can we discuss? If you are a trusted person, and you should be because you're their health insurance agent, right? They know you, they chose you for a reason, getting them to respond to that voicemail, getting them to respond to that email and have that conversation can be easier, all things said and done. And the other thing you can do, and you say, Randy, this isn't client reach out. Not yet. But what we can do to this is dress it up a little bit and make it seem a little more thoughtful than just shoving a client carrier flyer in front of your mailbox or in front of your clients. Everybody loves getting personalized mail. So if you have the time to handwrite envelopes, and I would wager that you should have the time to wager or to handwrite envelopes and address them to your clients. Everybody gets really curious about that handwritten envelope, especially from a name they know, like you, their health insurance agent. So they're going to be a little bit more likely to open that up. Inside, they'll see the flyer that talks about the plan, but they might also see a handwritten sticky note from you. Lots of my clients are adding this to offset potential costs. Call me if you'd like to learn more, John or Susan or whatever your name happens to be, along with your phone number there. The power of that handwritten note, gosh, well, nobody gives a handwritten note anymore. Everything is just text. Everything is an email. Everything's, a form letter. Taking the time to make that handwritten note shows your clients a little bit more, one more step of comfort, one more step of care that you're taking for their well-being. Could make them more likely to pick up the phone, give you a call, and talk about this product or anything else on your portfolio here as well. So, variety of different ways you can use to bring these up. I would love to hear you and see you experiment with those, and let your account manager or let Chelsea or I know how that is working for you as well. Chelsea, anything else to add before we head into our home stretch here today?
Not particularly. I think it's good to keep in mind how easy it is to add short-term care to your arsenal of things you can sell to your clients, because you don't need any extra education or anything to add this in. If you're already with Wellaby or with GTL, it's a quick little just getting familiar with it. listening to your clients, seeing when they might have a need for this, or putting it out there to your clients. It doesn't really take any much more work on your part to add them in. So, I mean, to me, this is a no-brainer.
That's right. As you poke around actually through the My Enroller quick quote that Chelsea mentioned, you can quote a variety of Wellaby policies. Same thing in GTL. You can quote all of their products within the same screen, not having to leave anywhere, and arrive at a pretty comprehensive supplemental benefits package for your folks. So you can see what the bottom dollar figures are for all those benefits they might be interested in as you go forward. Some key takeaways I want you to know from today is that Medicare is not the answer for paying for care in a facility, or paying for any kind of skilled care, because it has pretty firm limits about what it will pay for and how long it will pay for. Your clients are going to need something to supplement that Medicare coverage, whether it's their own income and retirement savings, or it's a short-term or long-term care policy to help offset those items. There are some key differences to keep in mind. Speaking of short-term and long-term care policy, short-term care policies, again, take care of about half of your client's needs. Long-term care policies take care of the other half of your client's needs, generally speaking. But long-term care policies can be cost prohibitive for folks. So that short-term care could be a way to provide them some much needed coverage, to protect them from the nearly inevitable case that they might need skilled care later down the road. Either carrier that we support here, Wellaby or GTL, provide some great options for you to start with. They have different approaches to how they built the benefits, but both of them do provide robust coverage for both in-home and in-facility care. Pick whichever one you want. Just get to know one of those well, as long as you already have that appointment for another product here. And again, talk to us about how you can help present these products or any other supplemental products in those appointments. Want to thank you for your time and attention here today. You can always get in touch with us on LinkedIn at the Action Benefits Company. Talk directly to Chelsea and I at learning@actionbenefits.com, or reach us at our main line at 248-356-8585. We'd be happy to direct you to folks who can help you add these plans to your portfolios, give you some deeper conversation about these, or figure out how you're going to present them in your next few appointments.